Welcome to the deep dive. We are cutting straight to it today. PDD Holdings Q3 2025 results. We're going right to the core figures and, more importantly, the forward guidance.
Exactly. The guidance is everything here. With a company this big, the numbers are only half the picture. We need to know if this margin squeeze we're seeing is an accident or a deliberate strategy.
Okay, let's dive in. The headline numbers at first glance look pretty solid. Total revenue hit RMB 108.2 billion.
Which is about 15.2 billion US dollars.
Yeah, and that's a 9% increase from last year. And the bottom line, net income, that looks even better, up 17%.
Yeah, absolutely. And for anyone tracking the ADS, the non-GAAP diluted earnings per share, that's up to about RMB 21 from, 18.5 last year? Solid growth.
Fine, and this is a big but. The moment you look past those headlines, you see the first signs of, pressure.
You certainly do. This is the real story of the report. Net income is up 17%, yes, but look at the operating profit. It barely moved, just grew by low single digits. And the really telling number, the non-GAAP operating profit margin, it actually dropped from 27% in Q3 last year down to 25% this quarter.
Okay, hold on. Why is that specific margin drop so important? I mean, for a listener seeing that strong 17% net income growth, why worry about a couple of percentage points there?
Because that specific margin tells you how efficient the core business is. When your revenue is growing at 9%, but your operating margin is shrinking, it means one of two things. Either competition is crushing your prices, or, and this is what's happening here, you are deliberately choosing to spend money much, much faster than you're making it.
And they absolutely have the money to do it.
Oh, absolutely.
The balance sheet is just astounding. As of September 30th, they're sitting on a mountain of cash. RMB 423.8 billion.
That's nearly 60 billion US dollars in liquidity. It's an unshakable war chest.
And they're generating more of it. Cash from operations jumped from 27.5 billion last year to 45.7 billion this quarter.
Exactly. So this margin squeeze, you have to see it in that context. It's not a crisis. It is a choice. And it's a choice made from a position of incredible financial strength.
So if it is a choice to spend, let's break down where that revenue growth came from and where all that cash is going. PDD has two main engines. The first one, transaction services revenue, that was the stronger of the two, up 10%.
Right. And then you have the online marketing services, basically their ad business. That grew 8%. Still huge, of course, but the key phrase in the management commentary was that its growth continued to moderate.
A slowdown in ad revenue growth.
Yeah.
That's a clear signal of market pressure, right?
It is. It means you have to work harder, and that shows up directly in your costs.
And boy, does it. The total cost of revenues jumped 18%. 18.
That's the number that explains the margin squeeze. And most of that is, the physical stuff, fulfillment fees, servers, payment processing. But an 18% jump in fulfillment costs, that suggests they're absorbing a lot of the logistics costs, probably to compete on price or speed.
But the real strategic spending, the line item that tells you this is a long-term play, is R&D.
Yes.
Research and development expenses. They just exploded, up 41% year over year.
41%. That's the punchline right there. This isn't just keeping the lights on. This is a moonshot investment. They're pouring money into core tech, into AI for their suppliers, into logistics algorithms. They're spending to build a platform for the next decade, not just the next quarter.
So the moderating margin isn't a failure at all. It's the direct result of an 18% spike in costs and a staggering 41% spike in R&D.
They're sacrificing today's profit for tomorrow's structural advantage.
And this brings us right to the strategy part of the call. This quarter is also their 10th anniversary.
Right, and management used that as a shame. They weren't just talking about a quarter. They were laying out a vision for the next 10 years.
Yeah.
A platform that benefits all people first and more open.
It sounds a bit philosophical, but it has huge financial implications. Co-CEO Jiazhen Zhao was explicit about it. They're prioritizing high-quality development over short-term results.
And to really get what that means, you have to understand this Costco plus Disney model they've talked about.
Right. Costco for the efficiency and the supply chain.
And Disney for the ecosystem, for creating that sticky experience that keeps people coming back, and that vision, it explains the spending.
It certainly does. I mean, the commitment is gigantic. We already knew about the 10 billion RMB fee reduction program for merchants.
Which is already a big deal.
But then they announced the first CNY 100 billion support program in the e-commerce industry. $100 billion.
It's a genuinely staggering number. I mean, to put that into context, that's one of the largest ecosystem commitments we've ever seen, period.
Yeah.
They are taking that $60 billion cash pile and just aiming it directly at building out that Costco Disney vision.
Okay, but let me push back on that a little bit. Is this truly a strategic choice, this ecosystem building? Or are they just being forced to spend this much to keep up with Alibaba, JD, and, ByteDance?
That's the billion-dollar question, isn't it? Management frames it as a choice to let go some of the profits for the good of the whole system. And the data, the cash position, it supports that this is a choice made from strength. But is the pressure real? Absolutely. It's both offensive and defensive.
And the confirmation of all this came in the forward guidance. The VP of Finance, Jun Liu, basically told the market to expect a bumpy ride.
He did. He said financial results are expected to fluctuate from quarter to quarter because of these investments.
And here's the key takeaway for you listening. He explicitly warned that simple, linear projections, they might not work for forecasting their future performance.
They're literally telling analysts, your old models don't apply here. They are signaling that volatility is now a feature, not a bug. That's a huge statement for a company this size.
And these choices are happening in a brutal environment. You mentioned the competition. Management called it increasingly fierce competition.
Exactly. They know that as they get bigger, the growth rate naturally slows down, so they have to deploy massive amounts of capital just to hold their ground, let alone grow.
And it's not just domestic competition. Their global business, which is only about 3 years old, is facing some serious headwinds.
Yeah, Chairman Lai Chen was very direct about this. He described the global regulatory environment as having unpredictable and difficult to quantify risks.
He mentioned trade policies, tax rules, data security.
All of it, across dozens of different countries. It just adds another layer of volatility, which again reinforces that warning from management. Don't expect a straight line.
But it's not all just risk and spending. We are seeing some early positive results from this long-term focus, especially in agriculture.
Right. This is where that high-quality development idea feels real. Agriculture sales grew by a massive 47% in the first half of the year.
47%.
Yeah. It shows that their long-term investment in that sector is really, really paying off.
And maybe the most interesting stat for the long-term health of the platform was about the merchants themselves. They're attracting the next generation of sellers. The number of merchants born in the 2000s, it's up over 30% in agriculture.
And up 44% in the industrial belts. This shows their support programs aren't just subsidies. They're successfully modernizing the supply chain and bringing in younger entrepreneurs. They're building a sustainable foundation.
So when you put it all together, that's the core tension in PDD's Q3 results. You've got this robust current performance on one side, 9% revenue growth, 17% net income growth, and that huge $60 billion cash pile.
But on the other side, you have management explicitly telling you to expect profit volatility because they are deliberately spending massive amounts of money, including that RMB 100 billion program, on long-term strategy.
The main takeaway seems to be that PDD is choosing to build intrinsic value. Supporting merchants, the ecosystem, social responsibility, over just maximizing the immediate profit number.
Exactly. They are funding their Costco plus Disney vision by consuming their current margins. It's a calculated long-term bet.
Which brings us back to that guidance, that warning from management that linear projection might not be a good way to projecting future performance. So the question for you to think about is this. How do you fundamentally value a company that is actively sacrificing short-term profit for decade-long vision?
What new metrics beyond just earnings per share do you need to start tracking? Things like merchant retention rates or the growth in those industrial belts. How do you assess a company that is deliberately playing a completely nonlinear game?
It forces you to throw out the old quarterly checklist.
It really does. And that is the true challenge presented by this latest deep dive into PDD.